Welcome back, everyone, to Not Your Advisor with NYU Grad on Tuesday, May 7th. I'm going to try to keep this short. I can't do 20-minute, 40-minute free paid podcasts every day, uh, but I've enjoyed doing them. There's been a lot of things to talk about, but less to talk about today. So I'm going to try to be efficient with my time. Let's jump right into the format here. So taking a look at breath numbers, we had 586 new highs versus only 98 new lows. Really bullish, right? Stay tuned. We had 54% of stocks advancing versus 41% declining. Looking at the 50-day moving average, there were 43% below the 50-day moving average and 33% below the 200-day moving average, which is about on par with where we were yesterday, but a big improvement from last week when we were kind of selling off before the whole FOMC middle finger chart pattern. Looking at the sectors is much more interesting. You had, well, if you had to guess which sector led after I tell you that the Dow finished near the lows almost, up 31. NASDAQ was down 16 near the lows, and S&P down, closed near the lows, but was up $6.96. Could you guess? Consumer defensive led the way, up 1.06. Then utilities again. Hello, utilities. Communication services, healthcare, real estate, basic materials, financials, industrials, energy. Where is tech? Oh, there's tech. Down 0.56%, and consumer cyclical down 0.71%. So it was a mixed bag session. I think the Bulls kind of fumbled the ball here because all of the momentum, especially in the morning, was stacked to the bull side. But I had posted on Substack Notes something that I noticed yesterday as well as today. The 10-year Treasury yields in the mornings, yesterday and today's session, were rallying. Meanwhile, that was putting a lot of downward pressure on the indices and risk assets. But once the cash session opened on Monday and Tuesday, yields started to sell off slowly all day, bleeding out, and risk assets all rose simultaneously. And then right around 1:45, there was some heavy selling. I didn't even see any news, to be quite honest. There was a lot of Fed heads talking this week, so it's probably that. I don't really know. I don't really care. But there was a sell-off in the afternoon. So what else kind of stuck out to me outside of that? So I guess it's not even a rhetorical question. Leave me a comment. If you are over the age of, I don't know, 35 years old and you've lived through the great financial crisis, and obviously you've lived through the pandemic shutdown, crash, and rally. But some of you are not old enough probably to have experienced the dot-com crash, boom and bust, slash real estate great financial crash. But my question to you is, and leave me a comment, I'll actually put a poll before I publish the show notes. Will you sell before Wall Street this time? And I'm curious to know because they are selling. Wall Street is selling. Whether it's every earnings release that comes out, whether it's every stock buyback announcement that is announced, whether it's a dividend announcement, whether it's a stock split announcement like Chipotle Mexican Grill, 50-1, whether it's an AI announcement, they are distributing their shares. Why? Why NYU grad? Why would they distribute? Well, listener, I'm just going to go through just the ETF holdings of the Mag 7. This does not include institutional funds like, Vanguard funds, all your 401k junk, just ETFs. Okay? And this will all be in the free section of the show notes, so you can click on the links and see the source, which is Tip Rankings. For Apple, there are 1,001 ETFs that hold Apple. There are 958 ETFs that hold Amazon. There are 910 ETFs that own Meta. There are 1,213 ETFs that hold Microsoft. There are 1,114 ETFs that hold NVIDIA. There are 704 ETFs that hold Tesla. There are 973 ETFs that hold Alphabet's Class A shares. There are 760 ETFs that hold Alphabet's Class C shares. So, I had posted, thank you to JJ745, who publishes a Substack, which I highly recommend you check out. So David Einhorn is on Wall Street, well known for his success shorting the market. He then went and broke off and started Greenlight Capital. And JJ745 had read one of my posts and forwarded me today's Bloomberg article. Basically, Mr. Einhorn said that markets are broken. And I was reading it, I was like, wait a minute, this sounds really familiar. And it just triggered my memory. I remembered listening to a podcast by Bloomberg back in February, Masters of Business with David Einhorn. I will embed the podcast. Actually, I'll just link the post about Markets Are Broken by David Einhorn in my show notes. And he kind of walks through the reasons why, but you can read it. But, one of the things that is pointed out is that with passive investing, with all of the white collar jobs that work in tech and in, corporate America who are just passively investing, right? What does that mean? Roth IRA, a 401k contribution, a company match, people just diving into ETFs, 0-day trading, 0-day expiration trading, day trading, FOMO trading. No one really cares about looking at balance sheets. No one really cares about finding what the true value is of an asset. You can have two identical companies that have, let's say, the same risk profile, same revenue, same earnings, same headcount in the same industry. But let's say one is 3x the size and of the other. When all of these passive inflows come in, you might get one of the two added to the S&P or added to the NASDAQ. And then all of these passive vehicles pump an exorbitant ratio of those incoming funds to stock one versus stock two, which just makes the problem worse. And this is a big problem in the market. And I'm sure you sense this, but hopefully you've been following my podcast and Substack, and I've been giving you evidence of such. And the ETF holdings is just one example. And my question to you is, if you are a fund manager or ETF manager and you need to sell $300 million worth of Apple, how do you do that? Or if you need to, forget selling, let's say I give you $300 million to invest. What are you going to do? You're going to buy Instacart? It's too small. It's not liquid. You can't get out. And you can't get in efficiently without moving the market. So you're going to go to Apple, Amazon, Meta, Microsoft, NVIDIA, Tesla, Google, because you can get in and out roughly unharmed. And with all of these inflows, there's going to be a time when all of these ETFs and funds need to sell before the other, right? So it's not even just you and me, the sucker that, they're playing here. They have to eat and kill each other. So when doo-doo hits the fan, they're going to be fighting each other to the exits. So you may want to talk to your financial advisor. Yes, I know we're rallying hard, okay? But you're going to have to come to a moment where you decide and put together an exit strategy for yourself. Because once the sell side sells, you have no chance. You have no shot. You're going to be the last one out, just like '08. So start thinking about this now. I'm not telling you to sell. I'm not telling you on Wednesday morning, sell all of your stocks. But if you have a good financial advisor, you better start talking to them, or start looking at your statements every week and every month. Because there's no volume, okay? Let's keep peeling this onion, okay? So I almost wanted to not even do this podcast today because it's just been so slow. And after I read Einhorn's article and then re-listened to the podcast interview, I just felt depressed. But okay, let's look at the volume today. The SPY. Today's volume was 46 million shares traded. The average volume typically is 70 million shares. The Qs, 29 million shares traded. The average volume is 45 million. IWM, which is the Russell, today's volume is almost 19 million. The average daily volume is 35 million. So there's no volume, okay? All of these ramps, these rallies, whether you're looking at the Mag 7 or whether you're looking at stuff that's been buried under the 50-day and are now just dead cat bouncing, it's on no volume. So you need to be very, very careful right now. What else stuck out? So, we did have 4 straight sessions with new highs beating new lows. That's a feather in the bull's cap, no doubt about it. Let's go through some of the strong names, and there were a few. And I'll cover some of these with the premium members individually. But you had rapid fire in all percents, okay? I don't want to say percent 20 times. Zeta Global Holdings up 18.3. Crocs up 7.7. Zillow up 3.17. Instacart up 2.71. Reddit up 2.34. Sweetgreen 2.24. Beazer Homes 2.15. That's all I had on my list. There were more, but on my list there were more weak than strong, and I follow, I think, a pretty good list. So here is the weak side. Palantir down 15.11% after being up 8% yesterday in the cash session before earnings, so they front ran that. Thank you, Wall Street. Datadog down 11.48%. Disney down 9.5%. Ferrari down 6.23%, Coinbase down 5.55%, Lyft down 5.25%, Carvana 5.13%, Bitfarms 4.69%, Sprout Social 4.21%, Tesla 3.78%, Affirm Holdings 3.11%, MongoDB 2.83%, Natural Gas down 2.79%, VinFast Autos down 2.27%, Marathon Digital 2.23%, Kehovani and Homebuilder 2.19%, PaySafe 2.17%. For free members, that's going to be a wrap. Keep watching Mag 7, semiconductors. Keep watching the 10-year yield and yield in general. It's basically inverse. If yields are down, stocks are up. If yields are up, stocks are down. Like tick for tick. It's really ridiculous. I posted on Substack Notes that it's really saddening because you can fire all of Wall Street. Just fire everyone. I'm talking about Jamie Dimon. I'm talking about everyone. Blank Fine. I'm talking about every broker, every analyst, every back office employee, and just close it. And just have Jerome Powell walk on stage every Wednesday at 2 p.m. and soothe the markets. If they did that,
nothing would change to how the markets are reacting. It's all based on the expectation of yields or where yields are in that second. It's really pathetic. But that's it for the free section. Premium members. Oh, before I wrap, I did want to actually go through housekeeping with everyone while you're here. So I figured out why some folks are not getting emails from me, and I'm not sure if you knew about it. So I want to kind of go through what I found out. So within the Substack app itself, there's a way that you can check a box to only receive push notifications from your subscribed newsletters and not receive emails. So in a few particular cases, that was what happened. The other reason why you might not be getting my emails is if it's going through a spam filter. So check those two settings out. I'm going to put in the show notes at the top how to check on the Substack app so that if you want my emails, you can go and make those changes in the Substack app. The other is one big favor to ask. It will cost you nothing to do. It'll literally take you a few seconds. If you have Spotify, if you have Apple Podcasts or an Apple account, if you can do me a huge favor and click on the two links I'm going to include in the show notes. It'll have the logo for Spotify. It'll have the logo for Apple Podcasts. Click on that link. If you're logged into your account, simply give Not Your Advisor with NYU Grad 5 stars. It costs you nothing to do, but if you value the work that I'm doing, free or paid, what that does is it helps other potential subscribers find the podcast in Substack through Spotify, through Apple, which obviously are much bigger ecosystems than even Substack. So if you can do that for me, I would greatly, greatly appreciate it. With that said, free members, I will see you all after the Wednesday session. Premium members, please stay on to go over some charts.